this video, we're going to talk about how the bank industry works. So what is a bank? Well, a bank is a licensed financial institution. In the US, banks are regulated by the federal government and individual states. In most countries, banks are regulated by the national government or a central bank. The main functions of a bank are to receive deposits that go into a checking, savings, or money market account. Those accounts are also called demand deposit accounts, which means you can withdraw funds at any time without a penalty. And the other main function is for the bank to make a loan, either a home loan, a car loan, a personal loan. They may provide you a credit card. There are an endless number of services banks offer. An IRA, a retirement account. You can invest in a 6-month CD and receive 5% interest, but the money is locked away for 6 months. They exchange currencies if you're going on vacation to another country. Some also offer safety deposit boxes. Let's talk about the types of banks. The most common is a retail bank, like Chase or Citi. There are many regional banks. Lots of towns, even small towns, have a bank dedicated to their community. Retail banks offer services to the general public and small businesses. And most of them have a branch office so you can conveniently get to one. Almost all banks now have online access, and some are only online. They have no physical location. These banks provide many services. The larger retail banks cater to high net worth individuals with services such as wealth management, tax services, and many others. Some retail banks also operate as a commercial bank. The bigger ones, like Chase, Wells Fargo, PNC, they offer services to large businesses, governments. These banks provide more services than a mom and pop retail bank. Most have physical locations, but there are some that are just online. And these banks are really important for the economy because they create capital, credit, and liquidity. If you want to open a new business, you can get a loan from one of these banks, and then you can employ people in your community. Then the big evil investment banks like Morgan Stanley or Goldman Sachs. These companies offer complex services and financial transactions such as underwriting, and they can also assist with mergers and acquisitions. And these clients tend to be pretty big, like hedge funds, pension funds, really large corporations. The last type of bank is a central bank, which is not for individuals like me and you. It's controlled by the government. And the purpose of the central bank is to manage the nation's money supply and its monetary policy, to make sure inflation doesn't get too high or too low. It controls interest rates. And the central bank is responsible for the stability of the country's currency, as well as the economic system as a whole. If you have a corrupt central bank, the economy will suffer. The central bank is supposed to regulate capital and reserve requirements for all the nation's banks. The central bank in the US is called the Federal Reserve Bank. Other examples are the European Central Bank, the Bank of England, the Bank of Japan, Swiss National Bank, and People's Bank of China. Credit unions are not-for-profit, while banks are for-profit. Credit unions provide a limited number of banking services, usually for the basic and repetitive tasks, like depositing money and loans. They're created, owned, and operated by their clients and are tax exempt. As long as you work in the same town or live in the same town as a credit union, you can apply to become a member. Members purchase shares in the co-op, and that money is pooled to fund the loans. When you deposit money into the bank, that's like depositing money into the co-op. And they usually have fewer locations and fewer ATMs than a regular bank. And they are federally insured, so there's really no risk. But they're not insured by the FDIC. They're insured by the National Credit Union Administration. Some people feel their money is still not safe in a bank. Your money is pretty much guaranteed in a US bank because it's insured by the FDIC, Federal Deposit Insurance Corp. It was created by Congress to maintain stability and confidence in the US financial system. It was created by FDR after the Great Depression. The FDIC supervises and examines banks to ensure that money they handle is safe. If the bank is making a lot of bad decisions, the FDIC can take them over. And the FDIC insures up to $250,000 per depositor per insured bank. So if you have $500,000, you may want to put half in one bank, half in another bank. You can also be fully insured if you have $250,000 in a savings and $250,000 in a CD. at the same bank. You're automatically insured if you open up an account at an FDIC insured bank. The banks fund the FDIC based on several parameters. How much money they have in deposits at their bank, how much they loaned out. Also, there's other risk metrics, maybe how much long-term debt they have, how much unsecured debt they have. And the FDIC does not insure money invested in stocks, bonds, mutual funds, life insurance policies, annuities. That is not insured. How do banks make money? It's actually pretty simple. The main way they make money is loaning out funds that were deposited at the bank. For example, I deposit $10,000 in my savings account and receive 3% interest. The bank takes my $10,000 and gives it to someone else as a loan, and that person pays 8% interest. The bank makes 5% on my money, the 8% minus the 3%. So if that money is loaned out for an entire year, the bank made $500 on my $10,000 because the bank received $800 from the person they loaned money to, and the bank paid me $300 on the money I have deposited in my account. So pretty much banks are in the risk management business. If somebody has really good credit, they may get an 8% car loan, but if they have weak credit, they may have to pay 10 or 11%. Because some people will default on their loan, so the bank has to charge a higher rate for the riskier person. So when I deposit $10,000 at a bank, that's an asset for me. Cash is my asset. But that $10,000 is a liability to the bank. So if you look on the bank's balance sheet, my deposit is a liability to them because they owe me the money. Even though it's a demand deposit, I can take the money out at any time. So if they loan out my money, they have to get money from someone else to give me, kind of like a Ponzi scheme. And if they don't have enough money, they may need to take on debt from other banks or the federal government. And the second main way banks make money is fees. They charge some people a monthly maintenance fee on a checking account or savings account or whatever account you have. There's ATM fees, there's overdraft fees. If you write out a $500 check but only have $400 in your account, you get hit with an OD fee. Wire transfer fees. If you close your account, it may be account closing fees. If you're below, say, $500 in your account, you may get hit with a fee. And there's a blinking fee now. You could blink in a bank, but after your fifth blink, you will get hit with a fee. There are hundreds of banks that are publicly traded. I think there's around 400, but feel free to email me and I could send you this entire list. It shows the market cap, revenue, and price to book of every bank. My email is in the description of this video. And the biggest bank in the world is JP Morgan, nearly 600 billion market cap, 161 billion of revenue, and price to book of 1.7. Price to book is stock price over book value per share, or its market cap over the book value of the company. Book value is assets minus liabilities in the balance sheet. This is how you value banks on price to book. The lower the price to book, the more appealing the investment. If you're looking at these two banks, this company has a price to book of 1, this 0.8. The 0.8 is better, but if you did more due diligence, you might see they loaned out a lot of money to some risky people. So it might actually not be as good. So you have to look beneath the hood of the car. These first 11 banks are diversified banks, meaning they're not just regular retail banks. They're also a commercial bank and investment bank. From number 12, PNC, down to like number 4 or 500, those are all regional banks. Their focus is on commercial or retail banking, not investment banking. The largest regional bank is PNC, Pittsburgh National Corporation. So that's the video. Let me know what you think about it. If you have other ideas, please leave a comment. Thanks for watching.